Good morning from Tokyo. My name is Agnes Seri. I'm the Deputy Head of the Capacity Building and Training Department of the Asian Development Bank Institute, ADBI. Welcome to episode 6 of our webinar series on the economics of climate change. With 1 hour webinars, this series is meant to provide initial knowledge and raise awareness on key issues. It is based on the idea that climate change and the required transition to respond to it adversely affect economies and public finances through diverse transmission channels. In addition, countries have a range of financial instruments and economic tools to respond to the climate emergency. Here, I'm referring to fiscal policies, budgeting, debt management, financial regulatory framework, industrial policies, and so on. These instruments play an important role in promoting climate adaptation, reducing greenhouse gas emissions, generating climate finance, and supporting more sustainable and resilient growth. With this knowledge product, we hope to improve general understanding of the economic and financial aspects of climate change, recommend economic and financial solutions useful for policymakers to build resilient and low-carbon economies, and strengthen developing countries' capacities to design climate strategies and align these strategies with national budget processes and investment plans. Episode 6 is entitled Impact of Green Industrial Policies and Climate Finance. Let me now invite the ADB Institute Deputy Dean Byung-Sik Jung to welcome you and introduce the theme of this episode. Deputy Dean Jung, the floor is yours.
Thank you, Agnes. Good morning, good afternoon, good evening. Welcome to episode 6 of our webinar series on the economics of climate change. This episode will focus on the impact of green industrial policies on climate finance flows. Responding to climate change requires significant increase in climate finance to make the necessary investment to mitigate greenhouse gas emissions and support climate adaptation of economies and societies. The International Monetary Fund estimates that developing countries in Asia need at least $1.1 trillion annually for climate mitigation and adaptations. However, actual investments amount only $333 billion, leaving a shortfall of about $800 billion. Addressing this immense financing gap cannot be done simply through public finance, especially given high public debt levels. The private sector has to play a stronger role to increase the total amount of climate finance and close this gap. According to the IMF, private sector share of climate finance must rise from 40% to 90% of the total in emerging markets and developing economies by 2030. And the progression has to be even larger in South Asia, East Asia, and the Pacific, as the share of private climate finance is lower there. Green industrial policies are strategies and initiatives implemented by governments to drive the transition to low carbon economy and foster the development of green technology and industries while addressing environmental challenges for more sustainable economic growth. They can include a range of measures such as incentives for clean energy production, regulations on emissions, subsidies for renewable energy technologies, and support for green infrastructure projects. The Inflation Reduction Act, announced in 2021 and adopted in 2022 by the government of the United States, is an example of a green industrial policy that unlocked climate investments in the United States. In addition, it has had a surprising positive impact globally as investment funds with our sustainability mandate received more inflows from investors after the announcement of the IRA. In turn, these sustainable funds increased their cross-border investments to Asia and the Pacific. Today, our webinar will dig into this case to understand what happened and highlight the factors supporting this success story. To what extent did the United States Inflation Reduction Act have a positive spillover effect on climate finance globally? What were the key channels? Which countries benefit the most from these positive flows? In addition, how would the Trump administration affect the IRA as well as private climate financing? What kind of policies and strategies did the benefiting countries implement? What are the lessons learned for the future? These are the questions we will try to answer today. So I wish you had a great session. Thank you. Over to you, Agnes.
Thank you very much, Deputy Dean Jung. All the bios of our presenters are available on our event webpage. So now let me start by welcoming our first presenter, Alexander Raabe, who is economist at the Economic Research and Development Impact Department of the Asian Development Bank. Today, Alexander Raabe will present the main findings of his research on green industrial policies. Alexander, the floor is yours.
Thank you so much, Agnes, for the kind introduction. Let me just go ahead and share the slide deck. Should be coming through now.
Yes, we can see it.
Just go into full screen.
So, perfect.
Perfect. Well, yeah, again, thank you so much for the kind introduction. It's a really great pleasure to be here and share some of our latest insights into green industrial policies and how they may have helped unlock climate finance for Asia and the Pacific. As you can see, this is joint work with Daniel Tecart and Tian Yuanzhe. And let me also highlight that this work has been featured in the Asia Pacific Climate Report, which we launched last October, and I highly recommend to read. Now, to set the scene, let me get us started with a reminder of the challenge. So really, the opening speech alluded to that. The global climate finance needs are vast and remain largely unmet. So the Climate Policy Initiative estimated that the world needs about $10 trillion annually in the space from 2030 to 2050 to address mitigation and adaptation needs. That's about 10% of global GDP in 2022 terms. Currently, we're only at about 1.5% to 2% of that. And so that means if we want to have a fleeting chance at meeting these global financing needs for climate change, we need to increase that financing by at least a fivefold. Okay, so these financing needs are then even larger here in our region in Asia and the Pacific. These charts here, which I've borrowed from the International Monetary Fund's analysis, are showing you the infrastructure investment gap as they relate to addressing mitigation on the left-hand side and adaptation on the right-hand side. And the gap is displayed by these green bits of the bars. And as you can see on the very top of each of the charts, for Asia and Pacific, the financing needs is really very large. In fact, the IMF estimates that Asia needs about $1.1 trillion annually to address climate change, with only currently about 300 billion available, meaning we're falling short by about $800 billion to be mobilized. Now, where is this money to come from? Well, we know that we're living in a post-pandemic times where debt levels of the public sector is still very high. At the same time, we also live in a higher for longer interest rate environment. And that means combined, it's probably very hard for the public sector to increase its contribution of climate finance, which means that it's the private sector that will have to contribute the bulk of this additional climate finance. And here on this chart, I'm showing you with the red bits of the circle, the contribution of where the private sector contribution stands right now. On average, in the Asian subregions, we see a contribution of about 40% currently, while the IMF has estimated that this number needs to go up to 90%. So really a staggering increase that is being called for. So now the issue is, at the same time, in many of our member countries, the domestic capital markets are still somewhat shallow. And that means much of this additional finance is probably needs to come from abroad, including from advanced economies. And it's in this context that we're asking to what extent industrial policies that are enacted abroad, outside of the region, are possibly contributing to plugging this financing gap here in the region and elsewhere in the developing world as well. So with that, this is my motivation for, so to say, looking into the US Inflation Reduction Act, or in short, IRA. Let me give you a brief background what we're talking about. So the IRA is really considered as the most ambitious climate policy in US history. It aims at reducing the US emissions by about 40% until 2030 relative to 2005 levels. And that actually goes a long way to achieving the 50% reduction that the US originally had pledged under the Paris Agreement. It consists of largely tax credits amounting to about $370 billion, but it's not capped, as it essentially depends on the take-up of households and firms. And some early evidence even suggests that it is effective in directing investments to low-carbon firms. Now, from this legislative history on the right-hand side of the slide, I just want you to take away two things. One is the date when the policy was the first time announced, and so that is the date when we think financial markets will have paid attention the first time really to it, and that's on the 27th of September 2021. And as you can glean from the rest of the table, there are at least two more dates that is being argued that investors may have paid attention to that. And that's a date in July 22, which relates to a major breakthrough within the negotiations, and then the final signing into law by then President Joe Biden in August 22. And I will refer to these dates later. Now, I've been talking about a policy that is enacted in the United States. It's a domestic policy primarily. And our audience might be wondering, why would this be relevant for the rest of the world? Why would this be relevant for policymakers also here in Asia? Well, to that, it's important to note that the IRA really sent a really important signal to investors globally. And to that, let me just show you this slide here, which captures measures of attention to climate issues. On the left-hand side, this is a measure, it's an index based on news articles that measure the attention to climate issues in 24 economies around the world, which we have grouped into sub-regions. And as you can see from this red dotted vertical line, that is when the IRA was announced, this is really where this attention to climate issues spikes. Okay, so this really shows you investors globally start to pay attention to this. On the right-hand side, we show an alternative measure. In fact, this is the Google Search Volume Index for the term green bond. And again, this index is spiking exactly at the time when the IRA was announced, the vertical red line, and because we think green bond is probably something that investors would have Googled for around the time when the policy was announced. Now, again, why is this important signaling effect? Well, because when the US government is announcing this serious climate action, this really means that any assets that are associated with more sustainable ways of running our economy are likely gaining in value, right? While at the same time, assets that are associated with the old ways of production, conventional or even brown ways of activities, those are likely to lose in value, right? So, and you would expect a relative shift in the returns of those assets, sustainable versus conventional. And this is what we can show in our research, but let me show you some evidence first that investors have actually acted upon this attention with their wallets, okay? And this is what my next slide will be about. This slide here shows you the inflows of money that investors, notably retail investors like you and me, are putting into global investment funds. And I have split these money flows here into flows into what are considered conventional funds, so including those that are still supporting brown activities, and sustainable funds with the red line. So these are funds that are considered to support the sustainable way of running our economy, including those funds that are particularly targeting emission reductions, right? And we can clearly see that around the time when the IRA was announced, again, this red vertical line, the inflows into sustainable funds continue to increase, while the flows into conventional funds start to decline. And much of the presentation will be about corroborating exactly that type of shift in flows from conventional to sustainable funds. Let me open a parenthesis here, maybe to explain the background about these global investment funds. So global investment funds have really become important as a financing vehicle over the last 10, 15 years, in particular for cross-border finance. Why? Because the regulations that came into place in financial markets after the 2008 global financial crisis have led to somewhat of a decline in cross-border bank lending. And these global investment funds have in part filled the gap. And in fact, as a share of cross-border portfolio flows, these investment fund flows represent about 60%. So it's quite a large share of entire portfolio flows. And maybe also to mention, portfolio capital flows is a very important component of total capital flows. Why? Because this is the component that is most sensitive to global financial conditions, as well as to the news. And this is what makes it so useful to take investment fund flows to study the subject, and particularly the impact of the IRA. Now, here I'd like to spend 2 slides to tell you essentially what we find. So 3 points. First is that we do see that the IRA really induced higher investments in sustainable investment funds worldwide. In fact, sustainable funds received up to 0.045 percentage points higher inflows to assets, and that's in comparison to conventional funds. Now, the number sounds somewhat smallish, but figure that this is actually a 100% increase on the mean. And in absolute terms, we're talking about $1.4 billion monthly flows additionally into these sustainable funds. Point number 2 is we see that the IRA triggered international spillovers in at least 2 ways. First, we see that flows into sustainable funds increased no matter where in the world they maintain their legal headquarters, or in other words, where they are domiciled, right? And it turns out that most of the funds that are relevant to the analysis are actually headquartered outside of the United States. So this is a first step of a spillover. And secondly, we also see that these funds are not sitting, they're not letting this additional flows going idle. They're investing this into their portfolios, right? And they maintain themselves a global portfolio in various countries, including in Asia. And so these flows into these funds in turn mean increased investments around the world. And my third point is we are now turning to the question, okay, is there anything that policymakers in the economies that are at the receiving end of these funds can do to harness more of these windfalls, right? And our analysis shows that adopting policies that are more effective in tackling climate change actually is an important signaling effect again to investors, and investors put more money into into those economies with quote unquote better policies, more effective policies in tackling climate change. And more importantly, there's a discussion about greening finance versus financing the green. And what I mean by that is the sustainable investment funds really only represent a sliver of the entire global investment fund industry. And so their additional inflows would not yet move the needle by a lot. What does move the needle by a lot is that we see that even the conventional funds do reallocate funds towards countries with better policies, with more effective policies. And this really unlocks a much bigger part of the cake of additional climate finance. Now Next, I have been talking now quite a bit about the sustainable investment funds, and many of the in the audience may be wondering, how do we actually know whether a fund is sustainable or labeled as sustainable? Well, there are notably two ways we are identifying sustainable funds with. The first way I'm showing you here on the slide, essentially what we're doing or what the data provider is doing is they're looking for certain keywords that are associated with sustainability issues with ESG. And they do that in the various languages, as you can see here from the slide. And they're looking into the prospectus, that is to say, the sales documentation of these funds. And if there is a certain share of these words represented, then this is taken as an indication that these funds do have some sustainability mandate, and they will be labeled as sustainable. We have another way of labeling in them as sustainable, which I will get to later, but this just as a first idea. Okay. Next, I'd like to give you a little bit of a stylized facts overview about these investment fund flows. You might be wondering where in the world, which countries and regions in the world are the largest recipients. And the chart here on the left-hand side shows you the cross-border flows into the various world regions scaled by the regional GDP. And you can see that Asia is coming in second here, just after North America. So really a big recipient. And on the right-hand side, I've broken down Asia in the top 15 recipient economies as a share of inflows to total flows, right, to the region. And here we can see clearly that the PRC and Japan are, of course, coming out as very important. But even smaller economies, such as Sri Lanka, are not going empty-handed. And that means that the findings of this analysis here really apply across the board. And maybe also as a footnote to mention, these flows here, of course, are now here, they're not scaled according to the GDP of the economy. So what looks small here for Sri Lanka might actually be very large for the economy, also to be taken into account. Second, you might be wondering, where do these flows actually coming from? Well, this slide here shows you on the left-hand side of each of the two charts, shows you where the funds are domiciled, okay? And the right side of these charts shows you where the money is flowing to, and then separately both for equity and bond funds. And I apologize, the labels have turned out somewhat smallish, but take my word for it that the most important domiciles for investment funds are actually in Ireland and in Luxembourg. That's the brown and the purple. And on the recipient end, here in Asia, the top recipients are in particular Japan, the PRC, Taipei, China, Australia, and the Republic of Korea. That would be the top recipients. Okay. Now with that, let me jump right into the results. So this chart here is showing you the coefficient from our econometric exercise. And the coefficient measures essentially the differential impact of the IRA on flows into sustainable compared to conventional funds. And if you want to focus on the bucket on the very left, which is testing whether we see increased flows into sustainable funds around the announcement of the IRA, so the 27th of September 2021, then we see a very strong effect when we focus on a time window that compares flows into funds 3 months prior to the announcement and 3 months after. This is the first bar, okay? And the star, the asterisk on top of the bar tells us that these results are statistically significant, or in other words, that is very unlikely that they may have arrived by chance. Now, it is, of course, in economics, the perennial problem to claim that we identify causal effects. And we are really unleashing a host of econometric techniques to make sure that we are getting as close as possible as our profession allows to talk about causality. One of those ways is by simply making the time window around the event that we want to identify as very small, right? So we're looking at even 20 days before and after, and then we are comparing also 5 days before and after. Why that is important? Well, because it makes sure that it makes it very unlikely that there is any other event that may have driven or that may have led to the same effect in terms of this pivot of investors from conventional to sustainable funds. And as you can see, the results still hold even in the 5-day window. Now, I'd like to go one level deeper in the analysis on my next slide. We have, on the previous slide, we had looked into the flows into these investment funds. What this slide is showing you is the flows that are specific to the relationship between a fund and the country it's investing in. Okay, so we are really looking at the country breakdown of a fund's portfolio, and we are repeating the exercise. We're checking the differential impact of the IRA on sustainable versus conventional funds. And what is really reassuring is that irrespective of the exact model specification, we find more or less the same magnitude of impact and also statistical significance. And I'd like to draw your attention briefly to the table below, which is essentially a report on controlling for. That means to make sure that other factors that may have led to a similar outcome are not driving our results, by looking into different dimensions of variability in the data. In particular, the first row, where it reads country times time fixed effects. This is essentially to make sure that any factors that are potentially important for an economy and that do vary over time are not driving our results. And an important one here is, in particular, the residents in this country not demanding additional sustainable funds. Why is this important? Well, because if we can switch off that channel, it allows us to say it is really the investors, again, the you and me, that have noticed the IRA and made the decision to increase the funds in a sustainable way. Okay. On my next slide, I've been talking earlier about how we identify sustainable funds. Now let's look at an alternative way. Prior, it was about these keywords, right, from the prospectus. What we now do is we look into the environmental performance of a fund. And what I mean by that is essentially to what extent the assets that a fund is holding, say, stocks of a company or bonds that are being issued by a country. So to what extent these assets are affected by ESG issues, okay? And the data provider, again, is doing this analysis for us. And we have then looked into the funds that score very highly on this environmental performance. This is the funds that we refer to as with high score in the blue bars. And you can clearly see, even if we identify sustainable investment funds in this way, we still find statistically significant effects, again, in the 3 months window around the IRA. And the results even hold when we compare the two ways of measuring sustainability of a fund. So again, with the environmental performance in blue and sustainable funds in terms of these keywords, that's in orange. And interestingly, the green bar in the third model actually shows you that if a fund is considered sustainable in both of these ways, the inflows into these sustainable funds are even stronger. Okay. You might be wondering which world region sees now the largest effects of these additional sustainable investment fund inflows. And it turns out that, in fact, Asia, again, features prominently here. So in terms of the cumulative inflow in percent of GDP for that region, we see that Asia, or the average economy in Asia, receives about 3% of GDP additional flows after the announcement of the IRA, right? So only Europe is ahead here, largely because the sustainable capital markets are somewhat more developed there. But that being said, Asia 3% is really a big number. Now, we have talked about climate policies earlier, so let me shed a bit more light about what policymakers can do in the recipient economies to harness more of that windfall. Why would that be important in the first place? Well, from a global investor's point of view, this additional climate finance that is being unleashed by the IRA is, of course, scarce. And as an investor, you want to make sure that the additional money that you're investing in is going into the most productive activity, because that will give you a higher chance of earning higher returns, right? And we are arguing that choosing more effective policies in addressing climate change is a good measure of the capacity of an economy to productively channel these additional investments into tackling climate change. We are using for this a particular index that is constructed by a data provider, that's Bloomberg. And this index, it's called the Government Climate Scores, essentially measures a government's or a country's progress in 3 pillars or in 3 areas. One is the progress on emission reduction. That's the first pillar on the left. The second is the progress on decarbonizing the power sector, right? This is an important source of emissions usually. And then in the third pillar, about how stringent the climate policies are. I will not go into the details now, as I believe we have our discussion centered around that later. So let me just jump straight to the results here. So what this exercise here is doing econometrically is essentially a repeat of what we've done before, except that now we are asking, how does an economy having a higher climate policy score, so more effective climate policies, how does that amplify, how does that change this pivot of investors from conventional to sustainable funds? And what we can clearly see here with the orange bars, that yes, we do find, again, statistically significant effect. That means the chance that this might have arrived purely by chance is very low. And what is really reassuring is that these climate policy scores matter even beyond other potential channels that may have amplified the effect, notably direct trade linkages with the US. We see no significance. As well as the openness of the capital account means an economy's openness to receiving foreign investment in the first place. And when we run a horse race of these various factors in the fourth model, we see it is really the climate policy scores that matter. And this is an important message to the policymaker that I return to in the end. Now, my last issue I'd like to discuss here is about this notion of financing green versus greening finance. I've alluded to that earlier. In fact, the issue is the sustainable investment funds really only represent about 10% in terms of the number and 3% in terms of assets under management of the global investment fund industry. So it is a small share. And if we now, with our analysis, can show that more of additional sustainable investments have been unleashed, then this refers to these 3% of assets under management, which is also to say, if we as policymakers want to induce as much of as possible additional sustainable investments, then it is about the conventional funds whose behavior we need to change, right? So, and what we have been doing in this analysis is then to check, well, is it maybe that the sustainable funds as well as the conventional funds that are reallocating their portfolios towards economies with a higher government climate score? Okay, so again, applying more effective policies. I'll skip the detailed econometric results and go straight to a back of the envelope exercise. So imagine that at the time when the IRA had been enacted in September 21, if at that time your economy had changed from the 25th percentile to the 75th percentile of that measure of the climate policy score, the economy would have received additional sustainable finance flows of $229 million every month, okay? And this adds up to an additional, and that's specific to Asia and the Pacific, an additional 3% of GDP of additional inflows. And we have to add that to the 3% that I had talked about before. So we are already talking about 6% of GDP additional sustainable investment inflows. The chart on the right, the pie chart is showing you that clearly the largest contribution is now coming from the conventional funds, simply by them accounting for most of the investment fund industry. With that, I'd like to conclude and summarizing that we have found that sustainable investment funds receive really more inflows after the IRA is enacted. And again, it's the announcement of the policy that counts. Why? Because investors see this as an important signaling of the government of the United States at that time becoming very serious in taking ambitious climate action. We have seen that policymakers can do something in terms of harnessing more of those windfalls, in terms of enacting more effective climate policies. And we have also seen that the fund managers are reacting to those policies by reallocating more towards countries with more effective policies, okay? And the combination of these two really leads to a significant increase in climate finance globally. Now, what does this mean in a nutshell? Well, on the one hand, it is certainly true, as generally in global finance, that especially smaller economies will to some extent depend on, well, not only global financial conditions, but also in this case, green industrial policies that are being enacted abroad. So there are these spillovers. But beyond that, it is really important to be ambitious yourself about enacting these climate policies to attract and retain climate finance. And I think the analysis we have run here is really just scratching at the surface in the sense that we can identify an average effect in terms of that policies, climate policies are being effective in attracting more. But I think more needs to be certainly done in digging deeper in looking into very specific policies, for example, enacting disclosure regulations, in de-risking, for example, through subsidized loans and various other techniques that have been put forward in the introductory speech. And that it's very important to carry on with that kind of climate agenda, even if larger players have a change of heart. With that, I think I'd conclude here and return the floor to Agnes. Thank you.
Thank you. Thank you very much, Alexander. Indeed, from your comprehensive analysis, it's really clear that an ambitious green industrial policy had a clear impact on global private climate finance, especially in Asia. I also like your concrete advice for the policy makers of the region. So now, as a continuation of your presentation, I'm happy to welcome our second presenter. I'm delighted to welcome Professor Sayuri Shirai, who is advisor for sustainable policies at ADBI and also professor of economics at Keio University. Professor Shirai, today you will discuss the main findings presented by Alexander, and you will share with us your perspective on policies and strategies policymakers should consider to benefit from new sustainable private finance flow and attract them. So Professor Shirai, over to you.
Yes, I hope you can see the screen.
Yes.
Okay, so before I start my presentation, I just want to give 2 comments to Alexander's excellent presentation. The first one, there is no question that IRA made a very big creative momentum, not only in US, creating a lot of private sector capital spending, and also created a lot of sort of finance industry, ESG industry in United States, also influenced the global investors. So it was very important. Another one more issue, IRA is very important because it's a long-term industrial and fiscal policy. It was supposed to provide 10-year tax credit, grants, etc. So having a long-term framework is very important. One more issue, it was very interesting to see this IRA announcement made an impact on capital inflow into the sustainable fund in Japan, United States, Japan in the PRC. At the same time, Japan is a net capital exporter countries. So if you look at the size of capital inflow in terms of whole ESG finance, is really tiny. So I think it's very interesting to distinguish between capital exporting country and capital importing country. And I think same thing probably apply to China, because China and Japan has a quite domestically large financial market. Okay, so having said that, so I'd like to start my presentation. So it's about industrial policy, financial policy, and it's very important to support low carbon economies. Okay, so as Deputy Dean and Alexander mentioned, so there are 3 key gaps in global climate effort. So one is emission gap. So there is a huge gap between the amount of emission each country committed to reduce and the actual emission data. There's a huge gap. And second, there is a big investment gap between the actual investment in low energy and low carbon in the sectors and the amount of investment needed to achieve net zero. And finally, there's also a very big gap between the actual amount of finance and the amount of finance needed to achieve net zero. So as today's presentation was emphasizing, so 2 policies are very important from a country's point of view. So one is a green industrial policy. So this is related to carbon pricing and emission control and environmental regulation and taxation subsidy. IRA is applicable to this taxation and subsidiary policies. But also government need to do a lot of policy to promote financial market. So we can say green financial policies. Disclosure is most important. And I'll mention about this in my presentation, most important factors to attract investors. Taxonomy is becoming very important because investor is concerned about greenwashing. So classifying what is green, what is transition, what is non-green is becoming very essential. Also, each government have to make policies to expand issuers and investors base. And then finally, greenwashing countermeasures is becoming very important. So when we look at the financial market, globally, there are 3 types of financial channels. One is capital market, the second is bank loan, and third is more like direct investment, so creating investment fund or blended finance. All these financial channels, the disclosure is important, but probably what is required in terms of information disclosure will be somewhat different, depending on the capital channels. For example, we pay a lot of attention to capital market. So this is related to stocks and bonds. And the target is not only professional investors, but individual investors. So we need to promote standardization and simplification of disclosure to attract various sorts of investors. So here the purpose is try to influence the investors' portfolio adjustment, and creating index is very important to incentivize companies to do more low carbonization activities. And then engagement through investors with invested companies using voting rights becoming very important. We also pay a lot of attention to the banking sector because banks engage with lots of small, medium enterprises, and Asia is dominated by banking system. And banks also needs to check the impact of climate change on their loan portfolio, but also they can adjust their lending condition, and also they can engage with the companies to promote their decarbonization actions. Investment fund blended finance is becoming important, but when we look at JETB or ETM, I think a public fund is very important, especially grants and low interest loans from advanced country. Also MDBs are becoming very important. So as I said, different type of information disclosures are needed for each financing channel. So, but the important thing is disclosure is essential. It's indispensable. Because better information enables companies to incorporate climate-related risk and opportunity into corporate risk management, strategic, actionable planning, and decision-making processes. And also recently, large companies started to pay attention to the suppliers' emission data, and then try to, some big supplier in US and Europe, and they try to have a more contact with the low carbon suppliers. So creditor investors, definitely information is essential because they need to make an assessment about viability and the degree of effort and progress of each corporate sectors in terms of climate action. Overall, we need to develop market to able to channel investment to truly sustainable and resilient solution opportunity and business model. So let's pay attention to the sort of a disclosure, which is essential to develop capital market and to some extent the financial system, banking system. So now we have ISSB, which took over TCFD guideline. This is becoming a global standard, so it's very important. So we also pay a lot of attention to the ESSB standard. If we look at the global standard, now TCFD guidelines are completely taken over by ISSB, and the bottom, at least 13 Asian economies already expressed strong interest in terms of adopting ISSB standard, including PRC, Japan, Korea, etc. So ISSB, in making it mandatory and promote understanding among corporate sector in terms of this ISSB standard content is very important. EU CSRD is also another very important global standard. It includes many parts of TCFD guideline framework. California just passed 3 laws related to the disclosure in 2023. One is a Scope 1, Scope 2, Scope 3 disclosure starting next year. And another one is disclosure related to TCFD guideline. And the third disclosure is related to voluntary carbon credit. So California also reflect the part of TCFD guidelines. So these 3 are becoming very important global standard. So finally, because time is limited, let me mention about Japan's climate policy. So Japan, the government announced that they like to introduce ISSB standard with some modification, not to the all listed company, but a major listed company listed in the prime market in a phased manner. So we are, I think, waiting for the clear decision very soon, but it's very important that Japan is going to introduce ISSB standard and make it mandatory to large companies. And in addition, the Japanese government announced that they like to issue what they call GX transition bond. So it includes sustainable and green and transition bond up to 20 trillion yen over the next 10 years. And in this way, try to attract the aggregate of private and public funding 150 trillion yen. So this is a sort of public-private total investment. So using 20 trillion Japanese government finance by issuing bond, they like to bring 130 trillion private sector investment. Now they just started, so they just started to issue this bond last year. So still, I think there are the amount of private sector investment into this area is still limited. But over time, as people understand the importance of this kind of a framework, probably we will start to see more private sector investment. Now, one interesting issue about Japan's climate policy is it includes increase in renewable energy and nuclear, but also they put a lot of emphasis on the use of hydrogen, ammonia in electricity, including coal and gas, and transportation industry and CCS carbon recycling. So Japan's climate policy is more broad. And so it's maybe very different from Europe, but probably many Asian countries will share this kind of approach. And then Japanese government also planning to introduce ETS, emission trading system. Right now it's voluntary, so very few companies really take it seriously. So over time, Japanese government is planning to introduce more, strengthened scheme of ETS, and eventually auction-based ETS for electricity sector from 2033. The challenge is that when the Japanese government say they like to do 10-year framework, but the Japanese fiscal budgetary framework is a single year. So it's very difficult for the government to make commitment for 10 years. It's very different from a US system. So in that sense, Japan does not have a multiple budgetary system. So it's a bit difficult to make a clear commitment in terms of fiscal support for low carbon activity for a very long time. So that's one challenge. Another challenge is that many environment expert domestically and abroad mentioned that what kind of carbon prices Japan is going to achieve at this stage is not clear. So I think this is for Asia, for all countries. We need to gradually strengthen the level of carbon prices over time, and to promote and create incentive for the company to do low carbon investment in innovation. So the level of carbon pricing at this moment is not determined, but is becoming very important. Another thing, when I look at Japan, I think we really need to increase public awareness about the importance of climate policy. Still, most of the public is not aware of the importance of carbon pricing, emission control. And so we need public education, probably starting from elementary school. So, and that is one challenge. Without public understanding about climate policy, who is going to buy low carbon goods and services? So public education is very important. We need to start from early childhood. So Japan just started this climate policy, and Japan like to do collaboration with Asia. So Asia share a lot of similar challenges. So it will be good if we can collaborate more. But I think also we need to share what challenges each country is having. Thank you very much.
Thank you very much, Professor Shirai. Indeed, policymakers have a range of instruments to support an adequate transition and attract climate finance flows. The Japanese example, including the challenges faced by the country, is very insightful. So thanks for that. So now we have a few minutes left for additional discussion. So I have a first question for both of you, actually. As we expect less of a focus on green industrial policies from the United States now and over the next 4 years, what kind of consequences do you foresee in Asia? Will climate finance flows decrease? Alexandra, would you like to start?
Sure, I'd be happy to. Thank you so much. And let me also take this opportunity to briefly thank Professor Shirai for these excellent remarks, and also for the encouragement to further differentiate between the net capital flows. So that's something we can certainly test for. Now, on your question, Anya, so let's start maybe with the facts, right? So the new US administration, they have withdrawn from the Paris Agreement, but there's still a year for this to take effect. They have rescinded on emission reduction targets, and more importantly, also immediately stopped the financial support for various climate initiatives, including also unraveling essential elements of the Inflation Reduction Act. Now, it's early days. The situation is still a little bit fluid. And let me also say, maybe as a remark, if you look at the in manufacturing investments in the United States that have been approved since the IRA was announced, it's actually Republican-held or dominated districts in the US that benefited most. So how eager we are politically to unravel this, it's still to be seen. That being said, I think, again, talking from an investor point of view and invoking again the signaling effect, much of the damage is already done. You see some governments, some countries around the world start openly to speculate about whether to adhere to the Paris Agreement. That being said, I think all is not lost on at least two accounts. One is that we have seen already basically a withdrawal of major financial institutions such as pension funds, asset managers, withdraw from climate commitments as early as late 2022. For example, there is the Global Alliance for Net Zero, GFANZ, which had been it had come to life at the Glasgow summit. And a lot of financial institutions were very enthusiastic about subscribing to this. And then around end 22, 23, they started to withdraw from that. So there are various reasons for that, but I would probably expect that going forward, there will be a much higher qualitative alignment of financial flows with, for example, emission targets that go beyond the pure marketing aspect, right? So we all know that part of climate finance, of the way up, so to say, there's a lot of greenwashing also part of that. I would expect this to decline, and this will in fact make money go to the projects that really tackle emission reductions and adaptation and are also bankable. That's number one. Number two is, yes, the US is stepping back, but other regions in the world are actually continuing, if not increasing, the momentum. The commitment to net zero in Europe, for example, is still very strong. The European Commission has just put forward the new Green Industrial Deal, which is large, promoting both investments, but also upskilling. And even here in Asia, for example, if we look at the sustainable bond markets, they're still growing very strongly, and governments are strongly committed to that. And also institutions like our own, the Asian Development Bank and other multilateral development banks, are stretching the balance sheets to take various initiatives to ramp up climate finance. So in a nutshell, if you consider all of this, I think all is not lost. There will be a moderation of these financial flows, but I don't see a cliff edge. And let me also say that we did already, using the analytical framework I have presented, we did already test whether the Trump election win made any difference, whether we were to see any reversal, right, from sustainable to conventional, and we cannot find any evidence for that so far. But again, it is early days.
Thank you, Alexandra. Professor Shirai, what is your views about this?
Yes, as Alexandra mentioned, I think GFANZ, it's very difficult for the US investors to participate in such kind of alliance. So I think it's going to be more individual, based approach. So at this moment, we don't know how US investor will, invest in Asia. But having said that, I really want to emphasize Asia can do a lot by themselves. And right now, what's happening is that, some like ASEAN countries, they try to do taxonomy, transition finance, which is a bit different from other countries. And then, now we are talking about voluntary carbon credit, but it's very, very individualistic. Just keep it like that. It will have a risk of a fragmentation. So we are not able to attract a lot of funds globally. And also within Asia. So, setting aside what's happening in US, we can do a lot, collectively in Asia, try to create some kind of interoperability or some convergence is very important. So right now, I'm really concerned. There are a lot of activity, but it's very individualistic. So, if everybody doing something different in a different way. So, even sustainability disclosure, ISSB is good, but a lot of countries doing also additional sustainability things. But if you become too specific to the countries, there is also we have to balance out with this risk of fragmentation.
Thank you. Okay, there is another point I wanted to further discuss with you, Alexandra, because I think it may be important for policymakers from the region. In your research, you used the Bloomberg Government Climate Policy Score. Could you explain to us in more details how it is built, and are there any limitations, and to what extent the policymakers should pay attention to this scores?
Yes, thank you very much, and yes, and thank you to Derek for putting up the slide. So here again an overview of how these Bloomberg Government Climate Scores are constructed. I've already talked about a broad brush across the three pillars. So let's look into these a bit more in detail. No, please stay on the slide. Thank you. So if you look into the carbon transition score, what is this composed of? Well, essentially, it's being looked at what is the progress here on the carbon emission reduction, both in terms of per capita and as of GDP. So it's telling you, and so to say, about the efficiency of using carbon in producing output. And also they are looking at the trends over time. That's the first component under the carbon, under the current performance. And then there's also this notion of the outlook, where they're comparing the current CO2 emissions versus a target that has been derived from a scenario from the NGFS. This is the Network for Greening the Financial System. And so in a way you get a measure of progress, and similarly for the national determined contributions. If we look into the power sector, again, we are seeing here the breakdown into the fossil fuel generation versus renewable energy generation. So we can really see how one is declining ideally, right, while the renewable energies are coming on stream. And then maybe I'll go to that in a second at a time. And then on the climate policy score, this is what I alluded to before about the stringency. So for example, how early does the government commit to becoming net zero, and in terms of the net zero target here, and also what is the government doing in terms of developing the sustainable bond markets, and particularly on the sovereign issues. Why? Because research has shown that this is an important catalyzer for also bringing in more private sector investment. If I can just switch to the next slide here briefly. So this is, there's, as a researcher and probably also as an investment professional, there's a lot to be liked about this type of score. Why? Because it's scientifically derived. We have seen there was a reference to the NGFS, which is a major network of central banks that are modeling climate change in a really scientifically rigorous ways. It is absolutely transparent. This is something that I, as a researcher, like a lot. I see exactly which indicators go into this. I see exactly the weighting. You can see here performance and outlook, each 50%, of which, again, I see the breakdown into the various components. So there's a lot to be liked about. And if I can go one more slide deeper, yes, on the power sector transition, you see also here, if we focus on the performance, fossil fuel and renewable energy generation account for 50% and nuclear 0. That is essentially measuring, do we see an increase in renewables, a decline in fossil, without at the same time increasing nuclear, right? So that's exactly following along the lines of the policy discussion. Now, limitations, well, first of all, at least with the data subscription that we have, I wasn't able to get a further breakdown in terms of customizing this index. This is something that I think I'd like to do to be able to focus into particular policy choices. And the second thing I think that is still lacking here is in particular some of a focus on to what extent a government is committed to and implementing many of the instruments that you have alluded to, both on the fiscal policy and the financial policies. So, for example, did the government already subscribe to the ISSB? When do they think to implement it? Is there a green taxonomy? And all these kind of financial policies to achieve the pivot to a more sustainable or net zero economy. I'll stop here. Thank you.
Thank you, Alexander. Yeah, so it's actually a good summary and a useful indicator. Finally, I have a question for you, Professor Shirai. You focused a lot in your presentation on climate disclosure. But could you further elaborate on other climate policies you mentioned and that policymakers should really consider? Is there another policy you would advise them to really consider strongly?
Yeah, so one is taxonomy. ASEAN is already doing a lot of things, but I think many countries haven't implemented it yet. So how to implement is another issue. So, whether we can discuss more Asian-wide taxonomy is one issue. One more issue, like I said in the case of Japan, Asia is depending a lot on the coal power plant. So they also have to focus on, reducing emission from coal power plants. So like CCS, hydrogen, ammonia. Okay. So technology is there, but it's still expensive. So, but at the same time, we like to attract foreign investor to Asia, right? So, but some people are really question about this kind of approach. So I think, in Asia, honestly, we can do more, a lot of dialogue, in what way we can avoid blocking, how we can, accommodate concern from, European investors. We need to have a more dialogue about this transition of hard to abate sectors, especially electricity. Yeah.
Thank you. Thank you for sharing this response, which is highly relevant, especially for Asian countries. So it's now time to close this episode. I want to sincerely thank you, our dear panelists. Today, we learned that setting a global long-term direction and maintaining the momentum is actually critical to generate a virtuous cycle to address climate change. Governments need to align existing policies, including industrial policies, to send consistent signals to investors. Countries with the most advanced climate-related policies are more likely to attract private climate flows. So this is also an important conclusion. And setting up an adequate regulatory framework to support climate disclosure and sustainability reporting, which can direct the investments where these are the most impactful to respond to climate change, is also a key takeaway, I would say. We also covered that policies that are consistent can enhance incentives for private climate finance. For example, phasing out fossil fuel subsidies, the creation of carbon markets, and greening the financial systems are key components to maximize the positive impact. Policymakers have also a big role to play to unlock investments addressing climate change through concessional funds, blended finance, and guarantees. It can also they can also implement tax incentives to make climate projects more attractive. And finally, as highlighted by Professor Shirai, there are also some key enabling policies and critical parameters we have to keep in mind, such as the pace of policy implementation, the timing, and also the public education of the country's population. Thank you again for joining episode 6 of the webinar series on the economics of climate change. The recording will be uploaded to the event webpage shortly. Please also take a few moments to complete our post-event survey because for us it's always very helpful to get your feedback. So thank you very much.
Thank you. Bye-bye.
Thank you. Bye-bye.
Thank you very much. Bye-bye.